Hi, this is Linda Eedes, and this is an update on the RECM Equity Fund, looking particularly at the second quarter of 2017 and our positioning currently. So the fund had a bit of a retracing during the second quarter. It was down 7.8% after a very, very strong rally since the beginning of 2016. If you look at the overall market, the JSE All Share Index was only down 0.5%. But if you look at NASPAS, which makes up 18% of that index, NASPAS was actually up 10%. If you strip that out and you look at how the rest of the market would have performed, taking that one stock out, the rest of the market was down 2.5%. So I think that gives you better indication of what's actually sort of happening in terms of South African equities at large, taking out that one global technology business, if you like. Our portfolio is obviously very much tilted towards local South Africa incorporated type stocks. Those are the businesses which have been through very tough times over the last few years. Their earnings are depressed relative to what they should be through the cycle. They're at very low valuations as a result. And that's really where we see a lot of opportunity in the local market. But of course, with all the sort of negative news that's been going on over the last quarter, that's also a very volatile area of the market currently, because that is very domestically oriented. So all the sort of news about the Gupta emails, sort of the ratings downgrades, political noise, and all of the uncertainty associated with that is most likely going to be reflected in the prices of local assets, those sort of businesses which are more inward looking than outward. So the businesses which came under pressure during the quarter, which are in the portfolio, include businesses such as Stefanuti Stocks, Omnia, Wilson Bailey Homes, Robex, and Hudeco. You're getting a very strong feeling for the types of businesses that would obviously have been impacted in the portfolio. Now, there is a lot of uncertainty out there, and how does an investor deal with uncertainty? Well, we believe that the best way that you can deal with uncertainty in your investment sort of opportunity set is to build a portfolio that is as robust as possible. A portfolio where you're buying assets at prices well below their intrinsic value, and then you want to basically populate the portfolio with as many of these as possible so that your overall return over time is not dictated by any one or two stocks in particular. And that's exactly what we've done. So one needs to sort of look through the noise and identify those businesses which will see through the cycle and where you can get a great business or even an average business at an incredibly low price, which stacks the odds in your favor of good returns going forwards. The other thing to think about is that if you think about sentiment and the effect that that's had on the market, it's quite interesting because a lot of investors in South Africa will have you believe that the rand is on the sort of brink of disaster as a result of all the negative news going on in the background. But if you look at the rand and how it's performed since the beginning of 2016, it's actually strengthened by more than 30% since that time. So that causal relationship, if you think about whether there's been more or less political uncertainty and noise during that time frame, it's actually almost negatively correlated with what the rand's actually done. Just out of interest, we believe that the rand is at fair value now, so it's really neither here nor there, but it is not substantially overvalued. It's not really priced from a fundamental perspective for a massive depreciation. You may see some volatility, but really it's trading sort of in the range around what it should be priced at, given inflation differentials between South Africa and other geographies. Turning now to the positioning of the portfolio as at the end of June. If you look at the top 10, you can see that it's a nicely diversified group of companies. You've got the investment holding companies I mentioned previously, Hoskin Consolidated Investments, that was actually slightly down during the quarter on the back of Tsogo Sun coming under pressure, RECM and Caliber. Both of these have a solid underpin of good assets. The telecoms company MTN, which is still struggling through a tough time. You've got the two biggest platinum producers in the world, Implats and Amplats. And that's probably the one area of the resources market where we still think there is substantial value. A lot of the resource stocks in the portfolio have been sold down quite significantly, but those two still offer value. If you look at the platinum price, it's really sort of languished at very low levels. It's actually come down over the last quarter if you look at it in rand terms. And we think that looking sort of further down the line, the platinum price does need to be higher than it is today for those businesses to be sustainable. And if you look at that and the businesses at current prices, there is still substantial upside there. So those are still in our top 10. Standard Bank still has a dividend yield of just under 7%, so you're being paid to wait for that situation to come through. Two turnaround situations, Technology Group and Altron, and mining company Centula. Sasol, and luxury goods company Richemont. So again, that's a far more diversified set of opportunities than you would have seen in the portfolio 2 years ago, when the majority of those would have probably been resource businesses. And that's positive because it means the opportunity set has widened and you're not actually reliant on one specific investment thesis being proven right. We know that as asset managers, we're not always going to be right. You need to be more right than wrong, but you are going to make mistakes, and the sort of more robust and diversified your portfolio, sort of the better you are in terms of coping with that. So looking at sectoral exposure, you can see the fund is tilting quite away from resources, and the biggest portion of the fund now is in the industrial sector. Quite a few of those are small mid-cap stocks that aren't actually available as an opportunity to larger asset managers. So we're sort of taking advantage of that very wide opportunity set, not only in terms of sort of where we look for opportunities, but also in terms of our size and what we're able to invest in as well. So to conclude, the RECM Equity Fund is a nicely diversified set of local value opportunities. It's priced to participate in the return to value. There's still a very strong tailwind if you look at that normalizing of that cycle between value versus growth. We're still in very, very early stages in terms of that sort of coming back to something more normal. And if you look at the portfolio, what's great about it is it's very different to the market. I think if you look at the market at the overall level, there are a lot of risks there. There's a lot of risk of permanent capital loss, lots of businesses which are great businesses but which are priced for perfection. And I think that one has to be wary of that. But the good thing about this portfolio is it sits very well away from those assets, and it sits with businesses which are very attractively priced and therefore represents very good return potential from this point onwards.